Welcome, everyone, to the October market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here, joined once again by Bob Paolucci, our founder and CEO. Bob, welcome. I can't believe it's fall.
I'm happy that it's fall. Best time of year, and best time of year for the markets as well.
Well, I think that is a great lead into the title of our presentation today. We should just get right into that. I mean, this is called The Calm After the Storm. If that's fair to say. We've talked in past webinars how the fourth quarter is historically good for the market, but I think we're going to touch on that a little bit today. And if you'd like, I can kind of go through the agenda really quick. We have 5 key items that we wanted to address today. We have to talk about the government shutdown. The media is all over this. They are treating it as a crisis of the day. So we will address that. We have talked about the 7 stocks that have had this concentrated return so far this year, where we are with it. We also want to look back at a couple of other topics that we have addressed, which is one, drawdowns, and we have seen some drawdown more recently, so it's important to address it, along with interest rates and how they are the market mover to the markets. And then we haven't talked about this recently, but really looking at money markets and where they are today with all of this flooding of coming in from given their high interest rates and how that can be fuel for the stock market overall. And then finally, inflation. We're going to talk about it again, but this time we're going to talk about shelter inflation.
Sounds like a plan.
Sounds like a plan? All right. Well, then I guess we can get right into it. Bob, why don't we kick it off with the government shutdown, which is, forefront with the media.
Yeah, the government shutdown, something we predicted 2 months ago, and something that was quietly kind of known to our politicians upon signing the debt ceiling deal. Both parties decided that they will punt out the decision around the 12 spending appropriation bills that cover discretionary spending only. So, Julina, I think there's a lot of confusion about the government shutdown and just a lot of false information. The government shutdown is when our politicians fail to agree on the specifics of the 12 appropriation bills that make up discretionary spending. That is it, period. This isn't, the debt ceiling. This isn't defaulting on our interest payments, has no impact to Social Security, no impact to Medicare, Medicaid, the military. There are some thorns in there where certain military personnel might not get paid during the shutdown, keeping in mind the government pays twice per month. The average length of a shutdown is 9 days. And there's a very good reason why it's usually less than 2 weeks because of paychecks. So again, it's the so far failure to agree on the items within the very small discretionary spending bucket. That's it. And the media is making it sound like the world is going to end. It is not. And this was known by both parties upon signing the debt ceiling deal. This is how they got it done. They said, we will figure out and argue about, how much is going to be spent on immigration, how much is going to be spent on all these various things. And, unfortunately, government waits until, the 11th hour to start these negotiations. And, you do have some dissent amongst House Republicans. And, well, they're in office. Someone voted them in.
Yeah.
And, they're duking it out as we talk through this. Look, it's not official yet. I think it's highly likely that the government will shut down. And I think it's highly likely that we should expect about a week, maybe up to 2, of the government shutting down because they can't figure out how to spend the small portion of the budget that is discretionary spending. But it's going to be okay. Don't panic about it. Historically, it's actually a positive market event, not a negative.
Exactly.
So we
Yeah,
put
I
this
mean,
put
we've
this
been here
definition.
before.
Yeah, we put this definition on the screen so you can read it, so you understand it's not what the media is making it out to be. Here's
Yeah,
a government shutdown. So going back to 1976, there have been 21 shutdowns. The one in 18 was overnight, but they do classify it as a day. The average length in days is 9.5 days. The average return for the S&P during the shutdown is positive 0.3%. So over a 9-day period, the market averages a positive return of 0.3 historically.
right.
12 months after a shutdown, the market averages a 12% positive rate of return. So,
Yeah,
this is not a market event, and it's getting coverage everywhere. And it just tells you that the media and politics is just they are getting too close to one another, and it's all driving us crazy. Uh,
absolutely. And
and
and I would just, if you're looking at the slide, the numbers that you just referenced are at the bottom of the page highlighted in the red circles
yeah,
so that you can see that.
very
And
helpful start, I think, to show to people.
absolutely. Yeah. Thank you for going through that.
So historically, for the markets, it's a non-event.
Yeah.
For the political careers of certain politicians, you would think it would be a bigger event. It's a non-event. People forget what happened last month, 3 months ago, a year ago, so on and so forth. So,
Yeah.
for
And dare I suggest the way that this is being handled, this is probably not going to be the last time we talk about this,
well,
right?
it could be because there might not be any room for discretionary spending in the future.
Yeah.
All right, we'll move on.
Okay. Well, we also wanted to address the 7 largest stocks that we've talked about this in previous webinars, but they continue to drive the return of the market if you can go through it.
Yeah. So the S&P 500, the market, the stock market, is a combination of value stocks and growth stocks. There are 10 sectors, 11 sectors now in the market. Real estate became a sector a year or two ago. So there's technology, utilities, energy, so on and so forth. The S&P is a marriage of all of those companies sorted by largest company to smallest. And the largest company has the biggest weight inside of the stock market. Then the second largest company has the second largest weight, right?
Right.
So it just so happens that the 7 largest companies are the 7 companies that are very positive so far this year. Now, keep in mind, they were the most negative last year,
Yeah.
but they are the most positive this year. Um, and that is what is holding the market up, has brought the market up, and is keeping the market roughly where it is. It's the weight of those top 7, just the top 7. Um, when you look at this chart, you'll see that those 7 have averaged an 81% return. So you glue them together, you get the average, it's 81%. So that tells you there have been some that are up more than that and some that are up
Right.
less than that. But on average, it's 81%. The blue
That's
line
the
is
orange line.
the
Yep.
blue line is the S&P 500. So the S&P is up about 11% um, so far this year. And if you equal weight, there's an index where if you just weigh every company in the S&P 500, if you weigh Apple at the same weight as, all the other companies, if you weigh Microsoft at the same weight, everything's equal weighted,
Right.
which is a good way to look at it. The market is not positive. It's actually down 0.2%.
It's come down in the last month or so. Yeah.
Yeah, it just tells you that there is right now a small sliver of the market,
Mhm.
a small sliver of the companies that have weight in the market that are moving the market up. That is, generally speaking, normal at the beginning of every bull market. Somebody has to lead, somebody has to go first, right? So
This
it's
is
not,
common.
yes, it's not as odd as the media makes it out to be, but it is something.
Yeah.
Um, so we started to see, prior to August and September, a lot more participation from all the other companies in the market. They started to wake up a bit, but August and September, they got slapped back into place, unfortunately. But so did some of the big companies. So we believe that we're going to see more participation from the rest of the market going forward.
Sure.
But as it stands right now, it is 7 companies holding the market up. So if you own a U.S. dividend paying fund or security, don't worry, these are good companies. They're just not participating in this rally yet. It's only 7 companies, and they're all
Yeah.
growth companies.
Yeah.
So
And the media has cutely coined them the Magnificent Seven.
yeah,
But I love looking at the white line and looking at the potential opportunity that has yet to come from all of these companies.
absolutely. Julina, we should run a chart next time. I think this will be fun to show last year. The 7 largest stocks were down the most.
They were not magnificent last
It
year.
was the rest of the market that was holding itself together as the big weights of the market had, come down 30, 40, 50% in some cases.
Yeah.
So, thank heavens for the rest of the market last year. This year it's trailing. The companies that fell the most last year, those 7,
Yeah.
have propelled the market higher.
Exactly. And again, common, we've seen this before. And I know you have another way of showing this market this year.
Yeah, so the S&P 500 is, the largest 500 US companies, but it's a small portion of the overall market. When you look at the Russell 1000 indices, you have the Russell 1000 value, the Russell 1000 growth stocks, and then the Russell 1000, a combination of, half growth, half value. This just tells you growth stocks are up this year over 20%. The balance of growth and value is up 11, which means value stocks have to be, close to zero. And they are. Value stocks, which are the home of the lowest PE, highest free cash flow, biggest dividend payers and growers, oddly enough, is flat so far this year.
Yeah.
So that is the part of the market that is actually cheap, quite cheap. And that is what tells us, oh, we are in a bull market. They will wake up soon.
Yeah.
There's a lot of value there. And you will see that going forward. So, when you look at your portfolio, you will see that your growth stock investments are up. Your value stock investments aren't. If you looked last year, your value stock investments did a heck of a lot better than your growth. It all balances out over time. But because nowadays everyone's time frame is counted in seconds, minutes, and days, not quarters and years, we do have to illustrate this to people to show, look, spread this out over 2 years. Growth stocks and value stocks are actually doing, or 3 years, doing good things together.
Absolutely.
Less of a disparity. You get these wide disparities in very short periods of time, typically less than a year.
Okay. No, that's great. And let's continue to talk about some of the short-term performance. We addressed a little bit of the volatility, which was expected, correct?
Yes, so absolutely right. We talked about this last month and the month prior. We're putting it back in here to talk about drawdowns and how normal they are, and how the vast majority of pullbacks within a bull market are in this garden variety 5 to 10% range. And well, right on cue, we're there.
Right.
We're there. So we also bring it up in this video for people who did not listen to last month's video, to show you that pullbacks are normal. More specifically, the more important chart is the next one, which shows the prior bull market, the great bull market from 2009 to 2020. The S&P 500 had about a 400% return. Now, keep in mind, it was over 11 years, but it's still a very good return. And that's compounded, so it includes dividends and all that fun stuff. But to get that return, you had to experience the bottom line, which are drawdowns.
Exactly.
So whether it be an up market or a bull market, there's always, fluctuation in pullbacks. And look how many pullbacks of almost 5% there were over that period of time. It looks like there was, a handful every year, because there was.
Exactly.
And then you have the less frequent and more uncomfortable 5 to 10%. There were 1, 2, 3, 4, 5, 6, 7, 8, 8 of them. And then the always unpleasant 10 to 19.999% pullbacks. There were 1, 2, 3, 4, 5 of them. Anything greater than 20% would be a bear market. So you technically wouldn't be in a bull market anymore. So this chart lists out all pullbacks during the prior bull market that didn't end it, which means these are pullbacks of 19.999% or less. And here they are.
And
So without riding the roller coaster of the bottom chart, you would never get the return of the top half of that chart.
exactly. Yeah. I think people,
Volatility and, discomfort and monthly ups and downs, daily ups and downs,
yes,
that is the price you pay for good returns over time. If
yes,
you do not ride that roller coaster, you will not get good returns, and it's very likely, if timed wrong, you will have negative returns, which is why historically the average investor, behaves poorly at the worst time, and your return over time looks completely different.
yeah.
So, behavior control, asset allocation, diversification, working with a competent person who can articulate what's going on, why it impacts you, why you shouldn't do something is so important.
Absolutely. Yeah, we've shown this slide before, but we know how much the emotions can control the behavior of the investments. And so even in one of the best bull markets in US history, to see how many pullbacks we've seen that were significant for people, it's important to keep it in perspective.
Yeah, and Julina, it could be argued that the second half of that bull market was one of the least volatile periods in the equity market in
Yeah,
history.
exactly.
Yeah, in calendar year 2017, there wasn't a single pullback of greater than 4%. That happened, I think, one other time in history, and you got to go into the Wayback Machine to find it.
Right.
So,
That
so
is not normal.
that is not normal.
Yeah,
So expect
that's a great point.
volatility always and often, but the angle in which the market moves
Yeah.
is, generally speaking, upward arcing.
Well, and I think we even have a good visual on that on this next slide.
Yeah, so that's year over year pullbacks. We just ran a sample of 1950 to 2020. You see that there are sometimes many 5% pullbacks.
Mhm.
Sometimes there aren't that many, but it is completely normal.
Yeah, no, that's a good point. And also we've talked about the volatility that we were expecting over August and September, but that also leads into some nice opportunity coming into the end of the year.
Yeah, hence the title of our presentation, "The Calm After the Storm." Well, here it is. It's just cute that August and September are known as the hurricane season, and it's also sort of a mini hurricane for the markets as well. You could see that the best months of the year are October, November, December, and you can throw in April and sometimes July. But to have them stacked one on top of the other, October, November, December, that's what creates a great Q4, right? It's the fourth calendar quarter, and those good months are glued together. So you get through the turbulence of August and September. I just want to reiterate, August is Wall Street vacation month. The computers shut down, people go away, the traders go away. So there's there's less volume. So, rumors can move the market down. When there's a lot of volume, that typically doesn't happen. September is a big Wall Street comes back from vacation. It is the fiscal year end for many entities. So they do year end planning in September. Pensions do a lot of rebalancing in September. And historically, if stocks are up more than bonds, they need to rebalance their allocation. They're very rigid. They have an investment policy statement that they are mandated to rebalance to a tight band, 60-40. They can't let it go to 70-30 or 50-50. They have to rebalance frequently, and almost to the penny. So you see a lot of institutions rebalancing. And again, in an up market, that means selling stocks to take some profits and move it to bonds to reallocate their portfolio.
Right.
And again, many other institutions. So you have some mutual funds and some big institutional active managers where their fiscal year end is September 30. They are making year end moves in their portfolio. Sometimes it's selling losers to take a tax loss. Sometimes it's selling winners to rebalance their portfolio and buy other things. So
Right.
you just have a lot of cross currents hitting in September. October uh, tends to be, in November and December tend to be the restocking, regrouping months. You have things like lots of buybacks by corporations happening. You have a lot of the negative being priced in before this quarter. Um, and the confidence of investors tends to turn positive
Mhm.
or more positive because it's holiday season. You're seeing your family, so on and so forth. These are real things. Just
Yeah.
tells you that the stock market is behavior driven. And that's why it's tough, I think, for engineers to look at the stock market and to say, wow, I thought I figured it out, but I was wrong. I can't figure it out because it's behavior driven and it's emotional. And
There's
that's
emotion around it. Absolutely.
yeah. Yeah.
And
So
especially in the short term, right?
especially in the short term. Absolutely.
Yeah.
Yeah.
And I
Yeah.
think it's nice to see as optimistic as we are about the short term. We are also optimistic about the longer term uh,
Absolutely.
opportunity in the market.
Absolutely. So again, to beat this Q4
Yeah.
uh, over the head of everybody, here is just looking back at when August and September are negative together. It's frequent enough to actually measure, and what that turns into for October. The average October after a negative August and September is usually quite positive. Think about it this way: when things go on sale, people buy them,
Yes.
right? So when stocks are on sale, people will buy them. When a sweater at Nordstrom or boots at Nordstrom go on sale, more people are prone to buy them.
Mhm.
Um, and then what that also turns into for the quarter. So what you see there is historically, when we have this setup, October tends to be a plus 4.5% month. The Q4, the full quarter tends to be greater than 7%. We're not guaranteeing this. It just happens to be, seasonally
Historical.
yeah, historically a good consistent pattern here.
Right.
So
Exactly. Thank thank you for going through that. I jumped the gun with my optimism on the longer term trend. So
yeah, that's all right. So the 10-year Treasury bond, and I've mentioned this over time. It is linked to the stock market, right? Generally speaking, you look at the stock and bond market as um, investments or assets that compete for your money. When bonds have a high yield, they do a better job competing for investor dollars, right? If you can get 10% risk free in the treasury market, and historically, the 30-year average return in the stock market is 10% a year, but it comes with a lot of risk. If you ever have 10% rates, uh, we will buy as much of them as we possibly can, right? It's kind of a no-brainer.
sure.
We've had about 20 years of close to zero interest rates, and we've come out of that. And rates now have come up to a um, acceptable level for long-term investment, right? So we're seeing 10-year treasuries now at about 4.5, 4.6%. That's as high as they've been in, well over 20 years.
Well,
And
yeah.
because of that, it the competition between stocks and bonds competing for investor money, right? It does do something else. It also changes the uh, PE ratio, earnings risk premium. When you look at stocks, how much risk do I want to take to get historically this expected return versus the no risk I need to take to get this lower, but fairly attractive yield, right? So this summer, it wasn't weak earnings. It wasn't, major shocks to the economic system or major market events that cooled the market off in August and September. It was this. It was this chart. It
Right.
was the end of July. The 10-year Treasury was just below 4%, and now it's well above 4%. So it was this rise in yields that created sort of a governor for the S&P 500 or the stock market to go up. And it's expected that, maybe the 10-year can squeak out another, you know, 10 or 15 basis points, maybe, but that the trend going forward is going to match more of the language of the Fed, that rates next year are coming down. And I think this rate will start coming down soon. If that does, you're going to see some pressure come off of the market, and it will allow the market to rise much easier. So I don't want to promise anything, but the setup going into the fourth quarter is setting up to be pretty good. So
Yeah.
stay tuned. I bring this up because this is very important. I will be talking about this for a long time. It's also something that all these computerized trades and high frequency trading platforms use to counterbalance their stock exposure.
Okay.
So
Yep. Absolutely.
stop there on that topic.
Yep. No, it's a great point. And again, I think it's a lot of reason for optimism in the longer term. Another reason for optimism, which I love, this is probably my favorite slide of the entire presentation, is just the massive amount of cash.
Yeah.
I think the media is, talking a lot about cash is king right now. And so can we talk a little bit about this?
Yeah, I mean it's really the ultimate fuel for any asset to go up in value. It's is there cash available to purchase a house? Is there cash available to purchase a car? Is there cash available to buy these, nice antiques? If there's cash available, that will sprinkle into the market, any asset class over time if it's attractive, right?
Sure.
So this chart's unique because this is just a chart of money market fund assets, not checking and savings, not bank account assets, not Fed deposits. This is money market funds, which are historically holding accounts within brokerage accounts that are meant to be invested, right?
Mhm.
You have the highest level of cash, the most amount of cash in history, sitting right now in money market accounts. That cash will go to two places, generally speaking, stocks and bonds. And right now it's sitting in high yielding money markets, higher than we've seen yielding money markets, because most money markets yielded zero for the past 15 years. So it's fair that some is sitting there, but there's too much. And as the money drips out of money markets, it's going to go to riskier assets, bonds.
Especially if the money market yields go down.
Yeah, bonds and stocks. So it's very likely this cash, as it moves into bonds, is going to pull yields down, move prices up,
Yeah.
and it's going to move stock prices up when it moves in. Now, it won't move in quickly. It has a history of moving in slowly, and that slow move with massive amounts of cash is something that supports and fuels a bull market. Period. End of story. You can run it through any chart. We have it right in front of you. You can see that 09 bull market is right on this screen. And as cash was depleted, it sent the stock market up. And we have no reason to believe that won't happen again, because it happens always.
Right.
That's just the way it works.
Meaning the bottom of the market, there is historically a correlation being at the peak of when these cash levels are elevated to where they are.
Yeah, you have peak levels of cash, usually at the worst time as an investor, because, if you think about the people that are sitting all in cash today, the stock market's up 10%.
Yeah.
You missed out on 10% already. And it could be more. So the longer you wait with a lower returning asset class to buy a historically high returning asset class, the more you miss out on. So then you're solely relying on, I'm going to be able to perfectly time a decline to step in, and then you go on vacation, you forget about it. So this chart is something that keeps bull markets alive for a long period of time. And we are now starting with the largest amount of cash in history to, be on the side of supporting this bull market. I think it's a pretty good setup here.
Yeah, absolutely. That's great. Thank you. And I think the last topic we wanted to hit on is we want to circle back on inflation, but this time talk a little bit about shelter inflation and why that's so important.
Yeah, so in inflation, the thing that the Fed seems to be talking less and less about nowadays, it's because there's less and less of it. And, a big component of inflation, about a third of our headline inflation number and almost half of our core headline number is shelter. Shelter is owner equivalent rents, mostly. And what you're seeing is the way the government measures it, it's very delayed. It's about a year delayed. What we have in front of you is the way the government measures it in dark blue and the way it's measured live using the Zillow index. And you can see the Zillow index started plummeting late last year, yet the government measurement was still going up. So if you switch to the next slide,
Yeah.
we'll show you, this one's tough to read, but look at the rectangle in red and then the blue oval that we circled. We're about to, for the next 6 months or so, roll off incredibly high inflation data when it comes to shelter, rent and owner equivalent rent. Some of the highest numbers that we've seen in decades is about to roll off. And some of these green numbers, these lower numbers are about to roll on. So, energy, which is historically volatile, has spiked a little bit. So that's going to add to the energy portion of the inflation data. But again, we think that will cool off pretty quickly, almost as hot as it, popped up. Shelter is a slow mover. And now that we have weaker shelter data showing up in the government data, we expect this big portion of the inflation number to start to cool off substantially, consistently for the next 6 months, potentially more. Because keep in mind, this thing is so delayed, it might actually show lower shelter, lower housing
Mm.
for the next year,
Yeah.
even if housing picks up because it's so delayed. This is the anchor to inflation.
Yeah.
This is the anchor. And you'll hear more about this, I'm sure, in the coming months. Just remember, you heard it here first. It's the shelter component that is going to bring down inflation and finish the job. This way, we don't talk about this again for some time.
Yeah.
Stay tuned. This is coming. And that
Yeah,
is
but it's important. It's important because the Fed continues to be laser focused on this, and all eyes are still on the Fed, and we're anxiously awaiting as to whether they're going to continue to pause or maybe at some point even start cutting.
Yeah, and for the record, here we'll talk about it. We've been talking about the Fed. Fed's done for months, right? The Fed has now three consecutive meetings without increasing rates while saying that they might. Um, that's not. They have to change their tune soon. So they are talking tough, but they're actually not acting tough. They
Yeah.
stopped acting tough a little while ago.
Mhm.
And they might continue to talk tough all the way up until the point where they just shock everybody and they decide to cut rates.
Right.
I think so. In their outlook, their quarterly written outlook. They don't talk about this at the live meeting. You have to read their outlook, which comes out the same day as the live meeting, mind you.
Yeah.
They have themselves cutting rates next year by 0.5%, and they have them starting right around summertime. We think our house view is that that's a pipe dream. They're going to need to cut rates sooner, and they might need to actually cut by more. So sooner and buy more.
Yeah.
And we say that because we can't find any economic data that shows strength. All the economic data is pointing down. And the Fed is going to have to come in
They have
and
to address that.
they have to address that. They have rates, admittedly, through their mouth, too high, well into restrictive territory. You have almost 8% mortgage rates, 24% credit card rates. You have 10% car loans are back again.
Yeah.
You have student loan payments restarting. You have an economy that is going to go through its excess cash quickly if it hasn't already. And the Fed, who wanted to get this job done in 2023, so they had no impact on the election, is very likely going to be impacting the election. You can see it in the polls. You can see it in the consumer sentiment numbers. People feel a slow economy. Not all people, not, most of our clients don't, But the mass person in this country, the mass consumer, is feeling the pinch of the economy. It is crystal clear.
Sure.
And Fed is going to have to do something about it if they want to stay out of the political crosshairs.
Yeah, that's great. No,
So
thank
that's
you.
one of the drivers, driving our opinion of the Fed's going to have to do something, take their foot off the gas pedal here, and
Yeah.
have to pump the brakes a little sooner than they're currently talking about. And the stock market is onto them. And stock markets look at it earnings,
Yeah.
saying, okay, earnings are going to go up. This is great. CFOs and CEOs are putting out their estimates, and the Fed is kidding themselves. They're going to try to keep rates as high as they can for as long as they can, which probably might not be that much longer. And then they're going to start easing. In easing creates liquidity. Liquidity is good for markets. It's good for the globe. It's good for everybody. So stay tuned. More to come. That is it for now. Hopefully, this
Yeah.
has been helpful.
No, I think that that's a great way to end. And if I can, quickly highlight what we've been talking about, the government shutdown is very possible, but historically has been a non-event for market returns. We also continue to see concentration in the market return this year. We were not surprised by the volatility over the last couple of months. Great opportunity going into year end, and also great opportunity for the longer term. How's that?
Agreed.
Okay.
As always, thank you for your business. If you're listening, even if you're not, we appreciate it. If you have any questions, you can reach out to us, your advisor, anyone on the staff. Shoot us an email, give us a phone call, stop in and see us, whatever you need. We're here for you.
Yeah,
Stay tuned. Good things are here. Better things are on their way.
absolutely. And thank you for your time, Bob.
Thank you.